Welcome to Did You Know, episode number 9. Let's get right into it. Did you know that US households still have around $500 billion in excess savings compared to before the COVID-19 pandemic that could support consumer spending late into this year, according to research by the San Francisco Federal Reserve? That's down from $2 trillion according to CNBC. So with inflation showing signs of cooling and a potential slowdown in interest rate hikes, the housing market could be headed for a soft landing toward the end of this year. However, it's important to acknowledge the concerns surrounding higher consumer credit card debt and lower consumer sentiment about the U.S. economy. The next few months will be crucial in providing insights into the potential future direction of the housing market. Monitoring these developments will help us make informed decisions as we move forward. Did you know that the Consumer Price Index rose 4.9% year over year in April 2023, the smallest increase in 2 years, according to the U.S. Bureau of Labor Statistics? Inflation ratings have weakened for 10 consecutive months from their peak in June of 2022. Households seem to be getting relief in categories such as food, energy, and housing. To me, this is positive news with regards to the real estate market. This suggests a potential easing of inflationary pressures and relief for households in terms of housing costs, which can contribute to a more stable and balanced housing market, affecting affordability and consumer sentiment. However, it's important to continue monitoring inflation and its potential impact on the housing sector. If this inflation cooling leads to stable interest rates and more inventory, that would be a win. Did you know a measure of consumer sentiment in the US fell in May to its lowest level this year amid renewed concerns about the American economy and elevated long-term expectations for inflation? The preliminary reading of the University of Michigan's Consumer Sentiment Index sank to 57.7, comfortably missing economists' expectations for it to stay close to April's reading of 63.5, according to the Financial Times. It may take a bit more than cooling inflation to turn around consumer sentiment in the long term. I think housing affordability will play a big role, such as stable or decreasing property prices, favorable mortgage rates, and access to financing options, which can boost consumer sentiment. When prospective buyers perceive home ownership as more attainable and affordable, it can positively impact their outlook on the housing market. Did you know that if you own an asset worth $1 million today, 4% annual inflation could escalate the value of that asset to $1.48 million within 10 years, even though your buying power will be about the same? Now, let's say you have a debt of $1 million today. If inflation is at 4%, the value or buying power of that debt would decrease over time. After a certain period, let's say 10 years, the impact of inflation would bring the value of that debt closer to around $520,000 in real terms. In other words, due to inflation, the debt becomes less burdensome as the value of money diminishes over time. I think it's really important to understand how inflation impacts assets, cash, and debt. So my question to you is it better to hold cash, assets, or debt during high inflationary times? Let me know in the comments. So that'll do it for this video. If you enjoy this series, please like and subscribe. I'll see you in the next one. Until then.